All right, happy Friday. Welcome back to Stock Market Weekly. I'm your host, Evan Medeiros, and we had some rotation out there in the stock market this week. We saw breadth expand. We saw some of the under-owned, under-loved sectors in the stock market working. We saw large caps sell off, and we've just got a little bit of changing of the guard under the hood. I think this is a great environment for traders. This, to me, is where you find a lot more opportunity. There's more dispersion. There's more individual stocks working, more of a stock picker's market. It's been a while, right, since we've had that. And hopefully, and we'll talk about it if we're going to get more of that throughout this episode. So stay tuned. Let's get into it here. Our sponsor, IBD, they've been helping make the show possible for many years now, and we've got links and offers for you, the listener, with their Market Surge and their IBD digital subscription. So once you get done with this video, check out those links in the description of this show. Now, front and center here was the Fed. This was Fed week, and we did get lower interest rates. 25 basis points was largely priced into the market, and we did get an immediate initial reaction up. Basically the Fed, in their true fashion, kind of gave us the rate cut and very much then entered a kind of wait and see disposition on data on whether or not anything else in the future is going to be coming. And we're used to this, right? I mean, the market now is chewing on this kind of pendulum where the Fed is kind of teases out and tests out the market's reaction as they come out with these different statements. Nonetheless, we did get a cut. We did see a number of dissents out there, and the roadmap, I think, for January is still unlikely at this point, 30% or so that we're going to get a cut. And so, we'll see how this goes. Notably, though, they did start also already increasing the balance sheet or buying treasuries. They are out in the market now, sort of going out and effectively easing. I think there's a $40 billion of purchases. Of course, they're not going to call it easing. They're going to call it normal operations, but there's already sort of liquidity and stimulus already coming back into the market. And that was a little bit of a surprise on how soon that was happening. Now, all good things must come to an end, because shortly after, hours after the market starts to get comfortable and complacent after the Fed is done, we get Oracle earnings after hours, and the stock once again is sort of getting sold off and scrutinized here, down 11 some odd percent, retesting the recent lows and sort of reigniting some anxiety in the AI sector, in the AI trade. And the earnings were good, but revenue was a little bit light. And really, what is central to this problem, I think, is more light being shed on just how concentrated those future purchase orders that Oracle has is tied to OpenAI, right? It is OpenAI that is really sitting at the bottom here. And there are so many dependencies being built up in the system on this one company, which, is going in some sense, head to head with something like a Google. Much more capitalized, right? Has their own cloud infrastructure. They released a model in the past week, Gemini 3, that made substantial kind of moves up the ladder, the benchmarks. And this shows you that, OpenAI's current market share, its dominance here, is really only going to fall here. And the market is obviously, the total addressable market is huge. But when you have a company like OpenAI that is basically competing direct with the hyperscalers, these massively capitalized and infrastructure built up companies, it is what is concerning, I think, to the market, right, is when you get these, maybe a mass exodus or a sweep to another model that jumps above OpenAI and threatens the user base, the install base, the paying subscribers. And so this is something we are going to continue to see play out. It is not done by any stretch. I do want to talk about Oracle some more. We'll look at the charts a little bit later. We also had Broadcom also throwing some shade on the AI trade a little bit later in the week. This was, again, a beat and raise out of Broadcom, but it the company suggested that they would have tighter future margins, and that also just not sitting well with Wall Street right now. So AI stocks, generally speaking, here under pressure this week. We're going to look at those charts in a little bit. If we look at the weekly performance, take a look at the leading index this week. It was the Russell 2000. So again, some small cap rotation, and look at the spread here between small caps and the Nasdaq 100, the QQQ. Our title of last week's episode was Mag 7 fatigue. We outlined the potential bearish action in the Qs as a potential lower high, and sort of went through a lot of that evidence, which, we didn't forecast it. We didn't say it's absolutely happening, but we outlined, kind of the evidence there that would suggest the Qs were in a vulnerable spot. That seemed to play out this week, and we're going to talk more about that when we look at the charts. Here's the S&P 500. Fed day was Wednesday, and the earnings on Oracle was Thursday, and then Friday we got Broadcom. So this was sort of the 1-2 punch here with the AI trades back to back, and really sort of, putting a damper on the end of week mood. Volatility didn't react all that much, and this is kind of curious to me. The market seems to be taking this in a pretty complacent fashion. Now, of course, we're looking at the VIX here. VIX tracks S&P 500. The Nasdaq 100 is what had the bigger move. The VXN, we can look at that later. I mean, it's higher, but it's still not that stressed or concerned. So it does seem like we've got a little bit of pocket of potential weakness here where the market didn't hedge up as aggressively as it usually does. A 2% down move like the Qs just saw, we usually see the VIX spiral up to 20 plus. We didn't get that this time. And that's interesting to me, and that's actually a little bit of a concern. Now, the United States dollar index also down this week and starting to really roll over here. And I think, this has been chugging higher for the past month or two. We only have a 3-month view of this. But now we're starting to actually roll here. So a little bit of a change of trend here for the dollar. The weakness is back on the table. 10-year Treasury yields, though, going higher, right? This is also a problem. We talked about this, 4.15. That was kind of the area where we were saying this is where you want to see this market kind of top out. And it tested it, it pulled back, it reversed, and then it closed strongly. So this is also a little bit concerning here for the market as the 10-year Treasury yield starts to get bid. Now, in terms of sector performance, there was a lot of things working. Breadth was good. Materials, financials, and industrials. We have not seen that leadership group in the top 3 in quite some time. They were up sharply this week. There were some big winners in these 3 sectors. On the downside, it was tech, it was utilities, it was energy. Those were your hardest hit. Now, 7 sectors, right? So as a lot as a kind of preamble here has a lot of kind of bearish little spins to it, but 7 sectors are in our bullish smart trend filter state, which is basically looking at price, volume, price action across time on the daily time frame. And we've got a good kind of leadership mix here. Even tech is still hanging on, but I would expect that this would start to turn down next week if there's follow through. We got 3 sectors in the yellow, and we've got just utilities standing alone here, still unwinding after a great year that they are, slowly sort of eroding those gains from. Now, 52-week high and low list. This is looking underneath the hood, and take a look at this. This is the best we've seen in some time, and I don't have a longer term chart, but we are seeing stocks hit 52-week highs right now. This is as of Thursday's data, so this doesn't have Fridays on it. And the 52-week low list is pretty small, right? So this is good. This is that stock pickers market, but it's just not the mega caps, right? It's not what we were used to for the first half of the year. And it's not the big semis right now. It's a lot of other, again, materials, industrials, biotech, healthcare, financials that are working in this tape. Take a look at the percentage of stocks above a 20 SMA. We're back up towards the highs here. And so again, you're seeing more evidence that there is a broadening out underneath the hood. Bitcoin is still lackluster. Again, I've been pretty steadfast here. I do not think that we are going to get a swift recovery back up to 100K plus, right? I've said that from a couple of weeks ago when we broke down here. I thought there would be a lot of motivated sellers. As soon as you start to get above 95 or so and you get closer to that 100K, yeah, we might get up there for a day or two, but it just feels like anybody that missed the train to sell above 100 is going to want to come back pretty aggressively. And I still think that's the case. I think Bitcoin, while it doesn't have to make a whole deep second leg lower, I think it just needs more time than most people expect. So Bitcoin's still kind of in a tough spot. And then we also have, what else? Oh yeah, I mean, just, yeah, retail sales and PMI. Yep. So that'll be worth watching. We're going to look at some charts here. We're going to look at some individual trade ideas. All right. So we've got some charts in front of us here. Warden TC2000. We're going to start off with the S&P 500. We'll switch over to the cash settled market. You know, we spent a lot of time looking at the price action here last week, and you can see that we basically topped out exactly where we were at the end of October, right? Now, the S&P 500 didn't quite break out to new highs here, right? Got close. It made a new kind of closing high on a daily basis, but in terms of making a new intraday high, it sort of failed a little bit there and got a little lackluster. On Wednesday, this was the Fed day, had a nice turnaround here on Thursday. Thursday was the tricky session because I think Thursday, the market rebounded pretty aggressively, put in some hammers. It had a big wide range day and it closed strongly. And then on Friday, we just came kind of pounding back down and testing those lows again. And that's what sets this up to a tricky situation, because I think a lot of folks maybe felt safe on Thursday. Even got stopped out at the beginning of the day, but then because it reversed so strongly, I think there were a lot of people kind of chasing back into the close, and then they were left scrambling again on Friday. So, S&P 500 still looks more innocent to me and not as bearish as I am on the Qs. The S&P 500 clearly has a level here around 6,900 that it needs to break above to really get that continuation pattern and continue the long-term uptrend. Until and if that happens, I would say that we are still sideways here, kind of carving out a range in this 8 or 6% level from, call it 6,500 all the way up to 6,900. Again, we're still sideways here. We could chalk this up to just a lot of noise that hasn't quite resolved itself, and I would be perfectly accepting of that analysis. We've basically at the same levels that we were right at the end of November, right? So largely the S&P 500 is still making up its mind. It couldn't quite crack the new highs, and it hasn't really rolled over and violated any downturn levels yet. The Nasdaq 100 is where I just have a lot more issues with and concerns, and we outlined a lot of these last week, right? We talked about the potential here of this turning into a lower high, and after this week's action, this sort of moves a lot more confidence into this being a potential lower high versus the October highs. And so going into next week, I think how we follow this up is going to be of utmost importance. If we see follow through and kind of a fast move back down into this range, and just as a reminder, the last two times that price has gotten, was around this 612 area, and I shouldn't say the last two times, but there were two prior occurrences where price kind of opened and got around this 612 level and had this huge move down, right? Price just moved fast through there. It happened back here in October. It happened here in November, just a week or two ago. And going into the start of the new week, which is also OPEX, we're going to be testing the top end of this range here. And the concern is that if we do get some follow through here, that it could be another kind of fast move down through this range where, for whatever reason, the supply is thinly traded and the market just gets a quick move to the high 500. So that's the bearish scenario. We have a rollover, a breakdown, a day one kind of close below this range here. And if you go down to an intraday chart, you now have kind of a 6 days worth of supply in a very tight range. You had some very tricky trading on Thursday, but now you have a break below and you have what could be your first lower high right here. So I think, I don't like going down to the 65-minute chart. I don't like getting that, granular, because I like trades that are more setting up over days and weeks and months. But I do think zooming in on some of this near-term action, if you're trying to catch or risk manage or, get on a short trade, that's going to be important early next week. If we can't get follow through, if this market cannot sell off and we start reclaiming back over 620, then all bets are off, right? If we start moving back over, essentially erasing the losses here from Friday, and the market just finds its footing and starts to float, especially into the holidays, then the short thesis is out the window. Then I'm a lot less bearish in the short term. But for right now, I have to be concerned about the positioning here of the Qs, as this looks like a potential rollover from this consolidation, from a potential lower high that could get us swiftly back into this range. And so that's the negative setup right now. We outlined a lot of the, we looked at the Mag 7 charts last time and basically said, most of them look terrible. Tesla, Google, Apple, okay, you're hanging out there in those three. Maybe that's enough, but if you have a lot of pressure on the others, and now pressure with semiconductors and some of the large cap, kind of semis that are hitting this now too, we're going to have some concerns here. So Nasdaq 100, I don't like the look. Russell 2000, a lot better. Obviously, Friday's session was not pretty, but a weekly chart here for the Russell 2000, we've got all-time highs. And we looked at a lot of the breadth measures earlier and some of the sectors that are supporting this. So for me, the way I'm playing this in my discretionary kind of trading accounts that aren't managed systematically with Galahad or Quant Rockets, I basically want to be short the Qs. I want to be long other things: energy, biotech, healthcare, individual stocks that are still holding up. That's kind of the way I'm thinking about it. I did manage to maintain my short Qs trade throughout this entire week. I almost got shaken out on Thursday, but managed to hang in there. Glad I did, because again, Thursday was tricky with this big tail turnaround. And the way I played this in my head was, well, I'll take off the hedge. If we get follow through up, I'll just take the loss on it if we start clearing above 630. And, of course, we didn't get that. So that's the way I am looking at things right now. Like we mentioned up top, the VIX is not that concerned here. And again, for the S&P, that makes sense. But even for Nasdaq vol, yes, it's a higher level, sitting around 20, because the volatility in the Nasdaq's always higher. It's still at pretty subdued levels, though, right? We didn't scream north into the 25s, and I'm kind of surprised that it's that subdued here. And I'm wondering if this is the break that, the fuel that we needed, where not enough people hedged. We'll find out next week, but that's an interesting observation. What else do I have for us here? Gold, which weekly chart started to get going this week. It was up 2.33%. Talk about consolidations and breakouts, right? Gold was looking very similar to kind of SPY Qs, where you're just going sideways, tight range, waiting for the Fed. And then we started to break out and we got some follow through. Friday, again, was not the best action, but we are stair-stepping ourselves higher. This continues to be one of the largest positions I have. I think it just straight up is the largest position I have, and it's having a great year. Of course, silver is what's stealing the show recently, as this trades like an AI stock. And we saw a lot of volume come in on Friday, maybe a little bit of short-term exhaustion in silver on Friday and for the metals. But generally speaking, I mean, it's just been romping and stomping to the upside. I also think gold miners is very interesting, right? Because gold miners started to break out to new all-time highs. Gold didn't quite get there, but on Thursday we saw GDX start to take out its October highs. So definitely some beta there. I had trades in these earlier in the year, but I don't any longer. But GDX, looks good as well. A little bit heated, but still strong. International stocks, so ever so often we kind of check back here and we say, oh yeah, they're having a good year too. In fact, much better than the US stocks. ACWX, which is the MSCI ex-US index fund, is up 29% this year. So world stocks outside the United States also having a great year. Small caps picking up, international stocks picking up, industrial stocks, right? Breaking out here. This is a notable breakout for XLI. It's been dead money sideways since August, since July. Here's the weekly chart, basically nowhere, just trading sideways, and it's starting to move this week. Again, Friday session wasn't wonderful, but it is new kind of rotation here. You can also see it in the Dow Jones. This has a different, kind of pattern to it because of the mixture in it, but also closing at new highs and trading very, very well. Financials coming to life this week as well. Like industrials, have gone nowhere for about 5 months and are now really getting pretty excited here. I don't have any exposure in financials, and maybe I should. I mean, I might have some individual stocks, but maybe more on the fintech side. But XLF here, notably breaking out, expanding, new closing highs, up 2%. That's impressive. That's where the rotation just flat out is happening. So that is the theme for this week. I think Qs, again, I think are guilty until proven innocent here. I'd want to see this back over 620-ish or so. And if this rejection fails, if this turns into a higher low, so be it. Hedges will go off and, we'll just have some long exposure on is the way I will personally be trading that. Let's look at our trading systems here. So our Galahad trading system still has Q's exposure on. It's had it on for pretty much all year, right? And it's a long-term trend following system, so it should. It will get out of it on a deeper sort of pullback, but it just hasn't done enough damage yet for this trading system to really care. Gold is still one of the largest positions, and it's still what's carrying the portfolio to new equity highs this week, in fact. We made an update to Galahad. We were working on this enhancement to the trading system, adding some long volatility insurance to it, maybe at a very timely spot, but we do have some hedges on now in the portfolio. So if we do get a quick sell-off here, maybe we have some downside protection that can keep us in line. But for the year, we're still close to 20%. I don't know where the number is now, but it's a good year for Galahad. Let's move over to our momentum model. And our momentum model also had some selective pockets of very strong performance here. We did get a good surge of buy signals kind of coming back. I want to highlight 3 on my favorites right now. So the first is PL. I'll brag about the big winner first. Planet Labs. This was a new buy signal for quant rockets this week. So we got involved in it on Tuesday, I believe, or Monday. Right in this consolidation zone, right as it started to kind of find some support, pick itself back up. This is always the risky part. This is earnings, right? So if you have earnings, you have to just be aware that it is a coin flip. That's just the way I like to think about it, on whether or not you will pay the price or get rewarded. This was a big move in PL's favor, all-time highs, big volume, and a breakout here. And so that was nice to see. I have full disclosure, I have a position in it, and that was definitely making a lot of the gains this week. I want to talk about NTRA because we flagged this one a few weeks ago and it's starting to pull back. We still like it. It's pulling back. It's not as extended. This is another kind of healthcare play, basically. And so this is where you can find some opportunity that's not large cap tech, that's in a strong uptrend, that's trading off of highs and is posting some really good performance. So NTRA, that one's interesting. And then Joby. This is a new one that also came on the list here. And I like the potential with Joby. Again, it's a high beta play, high kind of a more speculative type name, but this consolidation has been happening now for a few months. It's a smaller mid-cap company. It's lifting back up, trying to put in a higher low. It's working itself sideways here. And if it can start to lift up over 16, then it seems like this could get a nice trend back up. But this one is probably the most speculative here in terms of a price action perspective. So those are some of the momentum names we were trading this week, but there were a lot that were moving throughout quant rockets this week. These are just my 3 favorites. So that's it. I think that's pretty much everything I wanted to cover today. It was a rotation week. Indexes look a little vulnerable, potentially range bound, kind of double topping. We'll pay close attention next week. We'll look at these other sectors and we'll have some fun in this stock pickers market. So that's it for me. We've got links in the description of the show. Thanks as always for tuning in. Have yourself a great weekend. We'll see you back here next Friday. Take care.